All right. Happy Friday, everybody. So, about a week ago, maybe a little bit longer, I wrote something that annoyed some people about CPCs, specifically that a lower CPC or a lower CPM isn't always good. And that's been a topic that we've heard in the marketing community forever is, what's your CPC? What's your CPM? How much are you paying? And it's always been assumed that lower is better. And that's not necessarily true. So let's talk about why. And to do that, I want to talk about first an analogy. Let's talk about equities, stocks, right? These are assets. Just like clicks, just like impressions, they are assets. And when you think about what dictates a stock price, right, there's a whole bunch of factors that go into it. There's the expected return, which would be the earnings, the free cash flow, right, the financial position of the company, the interest rates of the macroeconomic environment, how competitive their space is, what the growth in their industry looks like, or what their individual firm growth looks like, what the macroeconomic growth looks like, overall investor sentiment. Investors are, known to be in their feelings sometimes about companies. And then there's miscellaneous, right? There's management, there's brand, there is scandal, there is emerging tech, right? There's 1,000 factors that go into asset prices. But fundamentally, these factors influence investors to either buy or sell an equity, and that informs the price, right? So basically what we're saying is this asset price is a reflection, imperfect as it is, of the underlying value of the asset itself, right? That's what price discovery is all about. It's about understanding what the value of that equity is. And when you look at a stock, you wouldn't necessarily say, oh, that stock is more expensive, so it's worse. I shouldn't buy this stock because it's $30 instead of $3. That would be a stupid thing to say, right? And people buy Tesla all the time. They buy Nvidia. They buy Berkshire Hathaway with its stock price somewhere north of $400,000 for Class A shares, right? Just because a stock is more expensive doesn't mean it's bad, doesn't mean it's good. It doesn't mean anything, right? Absent context, price is not helpful. So then when we get to marketing, why do we throw that entire thing out the window and say, well, a cheaper CPC versus a more expensive CPC, the cheaper CPC is better? Right? And what I did here is just charted this and used the biggest two factors that influence click and impression costs, which are the competition level and the expected return, right? And if you chart expected return from high to low and competition from high to low, you end up with 4 quadrants, my favorite little 2x2 matrix. And what you find here are the ones with high expected return and high competition get premium prices. That's what you pay the most for, right? Truck accident lawyer goes there if you're just going to talk about expensive CPCs, right? Emergency plumber near me goes here. And for good reason, right? These have super high intent and they have high expected return. You need an emergency plumber, you probably need an emergency plumber, and you're probably not super price sensitive about it. Conversely, if you go to the other side, low competition, low expected return, it's probably an informational query. It's a bargain bin. It is a low probability of success, low cost bet. It's a cheap penny stock versus a premium stock. But then sometimes you find things with high expected returns and low competition. Those are treasures, right? If you find those keywords, if you find those audiences, you want to put as much money into there as you can because it's going to print. And if you have something with high competition and low expected return, it's an idiot trap. This is where dumb people put their money. So if you are doing that, stop. If your competition is doing that, don't get in their way. So what does all this leave us with, right? I think the first thing is we need to really think about what we're buying when we're buying a click. Because too many people assume that, again, that click, all clicks are created equal for the same keyword, right? But if you chart it here, right, for the same keyword, it's not true. So here's conversion probability, right? Because the search is part of the conversion probability, but it's not all of it, especially when it comes to Google or Meta, right? Google and Meta are able to profile users. We're able to look at their entire behavioral pattern, their interest pattern, their transactional pattern sometimes. And make a very good probabilistic estimate of them completing your desired action, right? That's how smart bidding works. So yes, 10 different people can search the same keyword, but those 10 people might have very different intents. They might have very different conversion probabilities. And because the conversion probability is different, the cost is different, right? So over here with low conversion probability, there's a lot of those clicks available, but they're cheap. The high conversion probability, the people that are hot to trot, that are ready to go, there's relatively few of them, and so they are more expensive. So when you say, oh, well, we reduce the CPC on this term or this audience from X to Y, what you're really saying is we're making an assumption that the underlying asset value did not change. And what we did was get a better deal. What more likely happened is you substituted high conversion probability clicks or audiences or impressions for low conversion probability clicks or impressions or audiences. And you didn't do the math to ensure that what you were actually buying and what you were actually netting out was worth making that trade. Just because something is more expensive doesn't mean it's worse. In fact, price is often an indicator of the underlying asset quality. So if a click is super desirable, it might be because the click actually has the higher expected return. So how does this screw your ad account? Well, it's a good thing you asked. The other part of this chart here is click volume, right? You have, for many of these terms that fall into this premium or bargain bin CPC, there's a lot of the searches every month, a lot of the searches every day, right? For car accident lawyer in New York, simple search, there might be 10,000 searches for some variation or permutation of that term every week, just in the United States, maybe even more. The vast majority fall into this category. Low conversion probability, lots of them. Well, if what you said is, hey, I want to get the cheaper CPCs, what you're going to do is spend a whole bunch of your budget right here, if you imagine your daily budget on a bar, on these garbage, low conversion probability, maybe moderately expensive clicks. But then, later in the night, a great search pops up. Somebody that's ready to go, somebody that needs your service, that needs your help right now. Well, that's an expensive click. But because your budget went to this, you don't have enough budget to actually get this. So what you did here is you filled in your budget with these cheap, low value, low expected return clicks. And then when the actual really good one came along, you didn't have enough budget to capture it. Oopsies. Right? Cheaper is not always better. Sometimes, especially in niche areas where you have the data to be able to set a minimum or a maximum CPC, you are better off paying more because those higher prices are a result of higher expected returns. So, that's not to say that you should overpay for bad clicks. That's idiot traps. Don't do that. That's not to say you shouldn't do the math. You 100% should. That's not to say that you should not look at factors like quality score, expected ad relevance, landing page relevance, and try to optimize those so that you can pay as little as possible to get these high expected return clicks. You should. But what that is to say is just because somebody lowered a CPC or raised a CPC doesn't mean they are good or bad. All it means is that somehow the underlying asset value changed. And what you need to do is figure out why. What caused the change, and is that an acceptable trade-off? Don't fall for this thing, this shtick from so many PPCers, and I've just heard it yesterday from another agency, that we reduced CPCs. Yes, you did. 100% you did. They cut CPCs down by 30%. What they didn't tell you is that the actual number of sales fell by 38%. Good job. You spent less money on a per click basis, but those clicks were inferior in quality. The underlying asset value deteriorated to the point where saving on the savings from the CPC side was not even sufficient to offset the business loss as a result of buying lower quality, inferior clicks. So this isn't to say that CPCs are good or bad. It's to say that you need to think about a CPC like an investor thinks about a stock. A click is an asset. An impression is an asset. And that asset has an expected value over a certain time horizon. So if you're paying more, it could just be because you're buying a better asset. And if you're paying less, it could be because you're getting a crappier asset. So the next time you hear somebody talk about reducing CPCs or changing CPMs, remember, this is an asset game. The CPC, the CPM, candidly, aren't usually relevant. What's relevant is the value those assets provide to your business. So I hope this helps. I hope it creates a little bit of controversy. And most importantly, I hope it causes people to think a little bit more carefully about how they allocate money and how they think about CPCs going forward. Talk to you next week.